So thank you. It's a pleasure to be here today, and I hope I get a chance to meet all of you. I want to start back with Jeffrey's chart. And Jeffrey had a little chart in there that he said there are 5 things that got this started. And he had one called saving too little, borrowing too much. And I want to talk about that for just a couple of seconds. You know, this is not like 100 million American families woke up and said, I know, let's quit saving and let's go borrow. What happened is there's been an enormous shift in the economics of the middle class over one generation. So that basically, I'm going to do the really quick sketch of this and we can all go back. What we've had is we've had flat incomes for fully employed males. Fully employed male this year makes about $800 less in inflation-adjusted dollars than a fully employed male was making in the early 1970s. And what we've also had is rising core expenses. The family budget has actually shifted so that families in inflation-adjusted dollars over this 30-year arc are spending less on food, less on clothing, less on appliances, less on furniture. They're spending more on electronics, but it adds up to about $330. Nobody went broke over this. More on electronics. It's not consumption goods. Where the real rises have been, and all across this arc, has been in housing, in health care, in child care, in transportation, and taxes because they have 2 people in the workforce when you add up the total number of dollars that families are spending. So we've got families with flat incomes, rising core expenses, and so what have they done? The average one-income family back in the 1970s was putting away, think about this, 10% of their take-home pay they were putting away in savings. The median American family today has 2 people in the workforce, and what have they been putting away in savings for the last 4 years? 0. They put away, effectively, statistically speaking, nothing. So they put a second worker into the workforce. They spent everything that she brought to the table. They spent everything they used to spend in savings, right? They just stopped doing that and kept sending it out the door. And the third part, they went into debt. And they didn't go into debt just to get spa bathrooms and granite countertops. They went into debt to buy, the median American family moved from 5.8 rooms to 6.1 rooms. They picked up either a 3rd bedroom or a 2nd bathroom, but not both. And they borrowed lots of money to do it. And then let's just be clear, in order to meet the rest of their expenses, they hit the credit cards. They hit the credit cards, they financed more on the cars, they hit payday loans, every way you had to go. So these families now, we have 50 million American families today who cannot pay off their credit card bills. On average, they owe about 2 months of income, and they're paying interest on that income. Paying interest on that outstanding bill. The average family, kind of back of the envelope calculation, is probably spending somewhere in the neighborhood of about $1,650 a year just on interest and fees. A whole new expense that's not even accounted for when we talk about family expenses. Next time you look at the Consumer Price Index, remind yourself they assume you paid cash and that you have no credit expenses outstanding. Okay, so that's where the American family stands. The question then becomes, how do we get into this crisis? And because I've been instructed to, I'm going to kind of short circuit here to try to use it as a way to talk about 3 things that we might want to be thinking about over the next year or 2 for changes that might be helpful. And the first I want to talk about is I want to talk about consumer financial products, because in my view, that is where this crisis started. This crisis started in part back in the late 1970s, early 1980s, when we kicked out a law that we had had since colonial times, and that was usury. We'd had usury caps all across the United States. They predate the American Constitution. We had them in every state in one form or another. And then through the interpretation of a banking law that had been passed in the post-Civil War era, in 1979, the United States Supreme Court had to decide what some obscure language meant. I'll take you through it if you want, but the bottom line was it permitted banks to set up shop in one state with a very high usury cap and then export their credit cards, in this particular case, all around the country and use that home state's usury rate. As a consequence, the CEO of one of the very large banks went to South Dakota and said, would you be interested in raising your usury cap? I can promise you 700 new jobs. And they did and they did. If you've ever wondered why your Citibank bill is mailed back to South Dakota, there's the answer. And the consequence is South Carolina and Oklahoma and California lost the ability to control interest rates within their jurisdictions. Home mortgages soon followed with a congressional act in the 1980s, no public debate. Now, the consequence of this in a high inflationary period immediately in the 1980s had very small consequence. But over time, it began to change how consumer lending looked. Consumer lending had frankly been a pretty pokey business. You made modest profits, but they were quite reliable. That's what the mortgage industry looked like. The default rates on mortgages, you're absolutely right, was about 1%. Of course, back in the 1970s, the median first-time home buyer was putting down an 18% down payment. For the past 3 years, the median first-time home buyer was putting down, anybody want to know the number? Zero. Zero. And gosh, nobody could have guessed that default rates would have gone up when people had no skin in the game from the beginning. So let's just be clear about this. Now, the second thing was, part of how these products began to change is they began to change the average, according to the Wall Street Journal, the average credit card contract back in 1981 was a page and a half long because it had very limited variables in it, right? Here's the interest rate, here's the penalty fee, it happens, right? Pay it, that's the deal. The average credit card contract, according to the Wall Street Journal, by the early 2000s, is 31 pages long. And if you've ever read the 31 pages, you have discovered those additional 29 and a half pages did not get added to help the consumer. We shifted to what I call a tricks and traps pricing model so that consumers look at three things. This is what the guys who actually do the market research talk about. They look at the overt interest rate, the nominal interest rate, the one on the front of the envelope. They look at the prizes, frequent flyer miles. Oh, you're nodding, you have them. Frequent flyer miles, cash back, contributions to the Golden Retriever Rescue Fund. And they look at relationships. That's a company that would be warm and fuzzy. This is a company that signals success. And those are the three things consumers buy credit cards on. So the new model becomes, put those credit cards in the hands of every man, woman, child in America, a few dogs, and you'll make a little bit of money off every one of them in the transaction fee. Every time somebody uses that credit card, the merchant has to pay something back to the credit card issuer. So you'll make a little money, but what you also have is a series of lottery tickets. Because somebody will be a little late, somebody will stumble, somebody will get a little behind, somebody will go over limit fee, somebody will trip up somewhere in that 29 and a half pages. And that's where the sweet spot is. That's where you make all the money. Same sort of game happened in the mortgage industry. I know how we'll make more money in mortgages, said many, many people on Wall Street. They said, we'll sell people, mortgages only make real modest percentage rates, but that's because they're just 30-year fixed instruments. They're not very fancy. I know what we'll do. We'll sell them mortgage rates that effectively will return 15% rates of interest. How can you do that? Well, you can only do that if you give them mortgages that have a lot of tricks and traps, like teaser rate mortgages. Your bill will only be $400 for the first 24 months. You hit the 25th month, and the interest rate skyrockets, and there's a prepayment penalty if you have to refinance into a new one. Very profitable instruments. Okay, so here's the short version of what I want to say about that. We are regulating consumer financial products absolutely the wrong way. Usury may not be the right answer anymore. We may have more sophisticated ways to do it, but the real point is we have lost our regulatory way in this area, and the American consumer has paid for it. My view is we need something along the lines of a Consumer Product Safety Commission. Every can of soda, every candy, everything we touch, breathe, handle in America is regulated for safety at some level. You don't buy apples that are covered with carcinogens. You don't buy cosmetics that have ground glass in them. You don't buy infant car seats that collapse on impact. And yet, financial products, which, believe me, are products. They are marketed like products. They are treated like products. Financial products are not governed by that rule. They're governed by the rule of contracts. Hey, you read the 31 pages, you negotiated it fully with me, and you meant to be bound by that clause on page 17. We don't hand people a wiring diagram when they buy a toaster and say, you're supposed to figure out that right over there in circuit 24, these things were likely to burst into flames. Instead, we regulate them for safety, and toasters then compete to make them better for consumers. They give them better colors, they make them cheaper, they give them all the little razzmatazzes that make cute noises or do whatever they do. In financial products, we have a competitive market, but it has competed to add additional tricks and traps that make this expensive for consumers and mislead consumers about the kinds of risks they're taking. It's happened on mortgages, it's happened on credit cards, it's happened on payday loans. We now regulate, are you ready for this? Stop and think about the fact that in the financial services industry, we regulate by who the issuer is. So if you have a product that's issued by a federal bank, it'll be controlled by the OCC. If it's issued by a federal thrift, it will be the OTS. If it's a state bank, it will be the state charter, and they have separate. The consequence is we have created a situation of regulatory arbitrage, and that is where a company, in effect, says to its regulator, hey, you're giving me tough rules. Over at OTS, they'll give me a better deal. Up in South Carolina, they'll give me a better deal, or South Dakota or California. So that what happens is they move around for better treatment. And since the regulatory agencies, including the OCC in Washington, derive much of their budget from those they regulate, we end up with a circumstance where the American family is simply left unprotected. So I want to make a pitch that this is an area where we need some regulatory reform to level the playing field for the American family. I'll say just two more just to say they're here as placeholders. We need to talk about foreclosure mitigation because the drop in the market is now creating its own problems that's creating further drop in the market. And then one last pitch that I want to put in here. When we're talking about the economy, let's remember, however you want to look at them, every one of those American households, 117 American households, they are little economic units. Whatever you can do for the economic unit is something you do to improve the economy. Not all solutions start at Wall Street. Some solutions really do start at Main Street. If American families had better health care, they would be in better financial shape. If they had better child care, they would be in better financial shape. These are the areas where we're seeing enormous growth. If they had a way to send their children to college and a way to work off those loans that kids take out early on, then the American family would be in better shape. And it starts there. If the American family is healthier, if those 117 million units don't need to engage in deficit financing, aren't paying twice as much for health insurance in inflation-adjusted dollars than they were paying 20 years ago, if those units are back on their feet, Wall Street and the rest of the world is back on their feet. And in my view, any attempt to try to fix Wall Street, to try to fix the rest of the economy, without trying to help those American families directly, is doomed to failure.